know me. I was, up until the end of December, obviously CIO at M&G in South Africa for 7 years, and before that, head of fixed. So it's good to see you all here. Clearly, M&G, a global asset manager, and I think we're seeking to kind of demonstrate, I think, those credentials. I think nowhere, perhaps for South African investors, is that more important than fixed income, because you all face now the challenge that with potentially 45%, up to 45 offshore on Reg 28, then you're not going to be able to hold all of that clearly in equities, whereas when it was only 25, it was easy to hold just some global equities and some cash. Now, clearly, global fixed is a complicated asset class. It's not like equities. It's not homogenous. So let us talk a little bit about why it is we think that you should have some active fixed income assets in your South African portfolios. I mean, just a very simple piece of work looking at taking a kind of South African 60-40 balanced fund, 60 equities, 40 bonds, and gradually combining it with global bonds. Along the x-axis, you've got from 0 to 45, and then along the y-axis, the standard deviation of your portfolio, so the overall volatility, and we can see global fixed income is a highly diversifying asset class from a South African domestic balanced fund. So on that basis alone, I think it has an important role to play and in risk control. I'd also say you clearly need a manager that can demonstrate, I think, skill across a range of fixed income assets and markets with global reach, and I think we will aim to demonstrate that M&G has that. This is our investment track record of this team, and we have been here, I mean, as you know, I've been with M&G 27 years, but Richard Ryan, to my left, just passed his 23-year anniversary, based entirely here in London. Rob Burrows, I think, is close to his 20th, and Dave Covey is a relatively recent addition, I think, on 7 years. So, we have longevity of people, philosophy, and process. If you look at our 20-year track record there on investment-grade corporates, that's the top line there, 100 basis points plus per annum over benchmark. We also have a large book of business offering global absolute return, and Richard will talk about that. If you are, at the end of this, I should say, that if there are capabilities here that you think may be useful for your clients, then please reach out to your contact in South Africa, who will be able to put you in touch. I first want to turn to, apologies, before I turn to that slide, I first want to turn to this issue of global macro. I think we can't talk about global fixed income without kind of scene setting, and so I'm going to start with Rob. Rob Burrows kind of works in our team managing interest rates in government bond portfolios, and therefore well placed to, I think, highlight some of the issues going on in the kind of global macroeconomic environment and in rates. We've certainly seen, whilst inflation has come down significantly from the peak, it's still pretty sticky. And so, Rob, I mean, what's your take on what's going on in the global macro picture?
Thanks, David. So, yeah, the market in the last sort of 6 to 8 months has been really grappling with this idea of where we are in the economic cycle, and it's probably fair to say that the market has broadly got it wrong, at least to date. When you look at when I say we, I mean the collective nature of the market. We all thought that an aggressive rate hiking cycle would result in A, something breaking, or B, bringing about a nasty recession, or perhaps both. And this has really not been the case. The market's been incredibly resilient. And as a result, we've seen the market over the course of 2024 really pricing out all of those rate cuts that they had put in at the tail end of 2023. So just if we to look at the sort of the main core economic variables, we have unemployment pretty much at its lows across the board in the Western economies. Wages have been largely been keeping up with inflation, and as inflation has been coming down, in fact, real wages for the last 12 months have actually been positive. So a difficulty there for the central bank, but this picture here of headline inflation coming down significantly is certainly a positive for all of us, and as these COVID-related supply chain issues drop out on base effects as well as the energy crisis. But the real problem for central banks is the services element of inflation, and that remains stubbornly high, sort of in the region of 5 to 6%. And now, if we move on to sort of the growth outlook, over in the US specifically, growth has been robust. We look at Europe, it's been somewhat mixed. The more service-orientated economies, such as Spain, have fared reasonably well. The manufacturing-orientated, i.e. Germany, have fared relatively poorly. But on aggregate, they've done all right. And if we then focus on the growth, if we have a look at risk assets, which Richard will touch on, investment grade and high yield trading at largely their all-time tights, and equities at their all-time highs. And from my perspective, this is really not an environment whereby we need to be seeing an aggressive rate cutting cycle. And back to that point of where we're pricing only 2 rate cuts is probably about fair. Now, this next chart what we have is essentially just the evolution of the interest rate cycle. And we've moved to pricing approximately the 20-year average rate at about, let's say, 4.5%, particularly for the US. And we are at attractive levels. I'm not suggesting we're going to be moving to meaningfully lower rates, because I feel we're very much at risk of our anchoring bias, which essentially meaning that we expect central banks to cut rates aggressively or some sort of smallish sort of slowdown. So I think we need to be careful with that, but the absolute level of rates is relatively attractive now. And what is quite interesting here on the right-hand side is the shape of the various yield curves. And you can see from about 5 years and out, there's almost zero term premium across the board, which is very interesting, and we'll go on to in a minute, and this inversion of the curves at the front end.
I mean, let's touch on that, because clearly, I mean, curves are inverted because they're expecting rates to come down. But I mean, there were some pretty big fiscal deficits out there, and some corresponding large funding requirements that is going to require capital. You know, how are we responding? You know, how are you responding in portfolios to thinking about that impact on government markets and rates in terms of adding value?
Yeah, so I've got 2 charts here, which I think we need to sort of unpack the various parts of the market. The first being here is the 10-year yields versus the central bank policy rate, and we are at extreme levels of inversion, and we all know that an inverted yield curve means that the market has an expectation that there'll be a requirement to cut interest rates. The problem with heavily inverted yield curves is that the scenario that needs to unfold is one of which is significantly worse than what's initially priced, and the market has to move by more than the amount to offset the negative carry. So that's a very difficult position to find ourselves in, with being meaningfully long duration. So there's a very big disconnect here with the front end of the market. On the next chart, which is also very interesting and showing how the market is so divided, we have, just to quickly unpack this chart, the horizontal bars shows you the long run rate expectations of the Fed, and as you'd expect, they've been coming down over the course of the last sort of 10 or so years. But generally, this green line, the 10-year forward, sort of a barometer of long run rates, trades pretty neatly within that band. We can see it's now sort of meaningfully higher. Why has that come about? Well, there's two reasons why there's this big variation. The Fed in reality should be moving that higher and has been sort of slowly doing that. Their issue is they can't do it all at once. And from the market's perspective, there's this real big concern on the fiscal dynamics, which seemingly are not improving, and the supply that is to follow. Now, the US is very much a special case given its exceptionalism, but this is a problem across the West. And on my next chart, which is really concerning, is the UK and the funding that they have to do versus the GDP. And over the course of the next Parliament, sort of 5 years, the UK has to fund almost £1 trillion of funding, which is almost 40% of the entire outstanding stock of debt over the course of 5 years. And a result of this concern, the structural theme that we should see play out in the markets is really steeper curves.
Yeah, so I mean, it does sound like the markets have got some quite significant expectations for rate cuts that may be difficult to deliver. Given, I mean, I guess we heard from the Fed earlier this week that it's kind of already on a go slow. I mean, bear in mind, as recently as December, kind of 2023, we had 7 rate cuts priced into the US market, and the Fed now tells us we're going to get 1, and that presumably even that's data dependent, and we've got huge amounts of supply coming. So probably not a time to be taking large amounts of risk. I'd like to turn, I mean, given that I think that we're all aware the standard fixed income investment process that you probably encounter broadly, I think, across the market is one where the asset manager attempts to forecast interest rates and from that government bond yields. And Richard, I think it's fair to say that we tried not to do that. So, how can you perhaps help us in talking about how we think we can have an investment edge in a market that has got is so efficient, or you might certainly got a lot of people trying to deliver value and at work in terms of capital employed. So how do we create an investment edge and our investment process?
One of the luxuries actually of having been here for 23 years, other than a demonstrable lack of imagination, is that actually we can spend the time in thinking very hard about what our investment edge is and how we operate in marketplaces and how we compete against the market. And I think that there's a couple of really critical elements. We as asset managers only really have a few things under our control. And those things under our control are really how we organize ourselves, and they're how we think about markets and valuations. Everything else is really out of our control. We respond and react to every other factor. If we organize ourselves, I mean, as David has said, there is a traditional way of looking at fixed income and global fixed income. It's country allocations, it's duration, it's curve, it's FX, and there's a sort of an orderly process through that. But if we were to follow that, and we were to organize ourselves in the same way as everybody else, we were to organize ourselves by asset class bubble, investment grade or European investment grade, US investment grade, global absolute return, etc. If we were to combine those two things, a standard operating model and a standard way of looking at the marketplace, well, you wouldn't be surprised if I said to you then the net result will be a market standard return. It won't be anything exceptional. And David did show that the team's track record up front, and there is a 20-year track record of outperformance using a single approach and a single philosophy that is then applied to various market segments fairly consistently. And we choose to do those two components, those two things under our control, we choose to do differently. So we choose to organize ourselves differently, and we choose to think about the market differently. The easy one actually is the organizational one. We don't organize ourselves on the basis of an asset class. We don't organize ourselves on the basis of an asset class because I don't want to be sitting there in a small bubble of people who are all thinking the same way, all looking at the same market, and keeping those ideas within that narrow confine. Actually, rather than put the asset class at the top of the pile, we put the idea generation at the top of the pile. So we've got 10 or so portfolio managers who are constantly looking and sifting through markets. Not a particularly glamorous job, I'd say, turning over the same stones every day, looking for a different answer. But we're looking for things that are attractively priced. And then thinking, well, we found something. What type of opportunity is it? Is it just a European bond that looks good value versus another European bond? Is it one that looks good value versus dollars? Is it one that looks absolutely good value? And you can then think about, well, where does it sit? It goes into the Euro benchmark funds. It goes into the global funds. It goes into the sterling funds. It goes into the absolute return funds. And you can see that. But what you have is you've got a collection of people who are all focused on delivering performance and finding those ideas. So you instantly invert that hierarchy of wants. You put the idea at the top and the execution sort of further down, because then you're focused on finding those really good value bonds, irrespective of the title or the asset class label that you have. The second thing that we do is how we think about marketplaces. And I'd be delighted to step outside with a coffee or step a little further out with a drink and wax lyrical about what I think is going to happen in the world, how I think things are going to pan out, the politics of it, etc. But I would never put that in a portfolio. I would never put it in a portfolio because I don't think that we have any particularly fabulous insight over and above the thousands of economists and strategists and others that populate the marketplace that are constantly asking that same question, that are constantly looking at the same pieces of data. So if you can't forecast the future, which we don't think you can, how can you operate? Well, credit is a mean reverting asset class. And that's really fundamental. When it gets really cheap, you actually don't need to know what the driver is that pulls those valuations back. And equally, when it's very expensive, you don't need to know what the drivers are that push that back out to a more normal level of valuation. You simply have to have patience. You have to have patience and discipline in recognizing those levels of valuation, recognizing when the opportunity is there. And really, if you boil it down, it's asking one question. Asking the question is easy. Answering it is incredibly difficult. But asking that question is, am I being paid to take that risk? And if you are getting paid to take that risk, take it. But if you're not, step aside and be patient. The marketplaces today have lost a lot of that willingness to be patient. I mean, if we look at the next slide, you can see actually this is just a representation. The small dotted blue line is the spread on the high yield market, and the two solid lines are a representation of the spread duration of some of the multi-asset credit or absolute return funds that we run. But you can see actually, so that's a measure of how much risk we're taking at any point in time. But you can see how when spreads are low, take early 2021, when spreads are low and you're not being compensated for risk, we can take that risk off. We can bring that spread duration down. Did we know that inflation was going to get out of the bag and get out of control? No. Did we know that rates were going to go up 400 plus basis points across Western economies? No. Did we need to know that? No. We simply needed to recognize that you weren't getting paid to take that risk. And equally, as spreads then widen back out again, being able to ask that question, am I now being compensated for risk? Are we getting paid to do that? And then being able to reintroduce that risk into portfolios is what allows us actually to shift quite aggressively the portfolio dynamics to take advantage of marketplaces. And when it comes to filling it up, well, that's what Dave and his colleagues are here for, is to provide us the answer of, well, what is the risk in the credit that we're actually looking for?
Yeah, we'll come back to the credit research process in a minute, but maybe we can stick to, or just dive a little bit deeper into credit as an asset class. Rob already mentioned that on some metrics it looks pretty expensive. Yeah. What are we thinking about that? So you've said we think credit's mean reverting. What is that opportunity set? And I guess as well, we should touch on kind of risk control, because that's a pretty important part. How have we done that? And where can we add value there?
Yeah. So credit is in a sort of a push me, pull you world. On the one hand, the move by central banks to lift policy rates, the collapse in fixed income markets in 2022 has meant that yields have risen to a level that's now quite attractive. And if you wind the clock back a few years, we had zero rates, near zero spreads. You got no compensation for risk, and you were being asked to take, depending on the marketplace, 4 years of duration risk in Europe, 6 in the US, 8 in the UK. So you're being asked to take quite a lot of investment risk, but for no prospective return. So that's a wildly unattractive environment to be in. Obviously, as policy rates move up, yields move up, that disagreement, even if you're disagreeing with the market now by 25 or 50 basis points, you're no longer disagreeing with it by 400. You're no longer saying, well, this is an asset class I can't own. So we've seen this huge flow of capital into fixed income markets, really taking out that kind of underweight versus their strategic long-term benchmarks. That obviously that flow has driven spreads in a really long way. And you can see from the chart here, and actually if we looked at a much longer chart, we're actually at cyclical lows of spreads. And that to me is the interesting thing, is if you have a rates view, well, take the rates view in the right marketplace. So you would take it in Rob's marketplace. You would go to Covey's and say, I could express my rates view, my interest rate view in Rob's marketplace. But actually credit spreads are currently, I always have to be slightly careful about this because David, on my first day in the office, I think, told me that markets weren't door numbers, that valuations change. He probably used that with you guys in the last few years.
Profound.
Yeah. But valuations will change. But at the moment, that dive into that to yield has compressed spreads and really compressed them down to what we would think of our cyclical lows. And when we think about that very simple question, do we get paid to take that risk? Well, actually, if we look across marketplaces now, the sort of horizontal green lines are the 5-year range of spreads, and the little triangle is where we are today. If we look at that, we are actually, irrespective of marketplace, right down there on the left-hand side of all of these charts. We are at the expensive levels. Yes, there's a few things to do, and I'm loath. I am a bond investor, so I am naturally negative. There are a few things. There are a few things there. Financials look fantastic. Actually, they've really, and I'm old enough to remember when banks used to trade inside of industrials, and I think we're going back to that type of world. So I think there are, on a sectoral level, there's quite a lot to do. In jurisdictions like Europe, there's lots to do anyway because you've got all these different countries doing different things, pulling in slightly different ways. That always opens up interesting opportunities. But cyclically, I would say at the moment that credit spreads look expensive. Now, that doesn't mean that it's an asset class you don't want to own. What it means is it's an asset class that you want to own, but with the flexibility to respond to those market valuations. So we currently are preparing ourselves for the eventuality that spreads would widen out. Whatever the catalyst may be, we've got the necessary precursor for that, which is valuations. But we're preparing ourselves to be able to respond to that market as it reprices wider.
Mm-hmm. Yeah, I mean, I think it's perhaps a useful at this point to actually turn to Dave Covey and talk a little bit about, how do we do those kind of deep dives into individual credits? I mean, there are thousands of companies issuing bonds in the listed bond market, as well as in private. We have a team of almost 50 analysts covering just the public credit markets that Dave heads, but the rating agencies also have got big teams, so people might kind of say, well, I'm happy to rely on Standard & Poor's or Moody's or Fitch or, and why can't we just do that? So, I mean, Dave, do you want to talk us through a little bit, how does your team add value, and how do we kind of think about looking at those opportunities?
Yeah, well, thanks. I mean, it's very much relates to the process, that Richard was mentioning. We add value because markets are not always efficient, because we have a big team, and because we follow this process quite rigidly. As Richard was saying, we can't predict events, but there are pricing anomalies in markets. It doesn't always happen, but there's enough bonds out there that there usually are some where markets may overreact, or there are other reasons for inefficiencies or volatility. And I'd even argue in some cases, you can make an argument that markets are less efficient today than they were, many years ago, at least within fixed income. So we do get these market overreactions quite often. It's quite surprising, but we obviously can't predict them. We have Russia, Ukraine, we have COVID, we have more recently the French elections. So they do happen from time to time, and when they do happen, we want to be prepared. So we can't predict them, we don't try to predict them, but we can be prepared for when they happen. And to be prepared, we need to cover our credits very closely and cover the vast majority of the universe, so that when any one of those events happen, we can determine and be very quick in helping the portfolio managers know which credits are resilient to the event and which credits are more at risk. So, Richard has said he likes to be, he's reactive to what's available in the market. We like to be proactive when it comes to research. So we're proactive on the credit side and the credit analysis, and we're reactive in terms of taking advantage of what happens in the markets. But we can't do that with a small team. I don't know a shortcut to going in deep dive fundamental research. And our team focuses probably 80% of our time on understanding the fundamentals of our sectors, our credits, and the industry. And so we like to dig into the weeds. We do our own work, and we don't rely on the rating agencies. Because again, if we just relied on other people, we relied on sell side, we'd be doing what everyone in the market does, and we wouldn't really have an advantage.
Sure. Yeah, I guess as Richard said, you need to organize yourself in a different way. I mean, do you want to make that, can we make that concrete? Can we talk about some, specific example and maybe that'll bring it to life?
Yeah, this is a great example, and I'm happy to talk of any others if there's questions out there. But you'll all remember what happened last year with Credit Suisse. I think you'd have to be under a rock for quite a while if you don't. But it's interesting because with Credit Suisse, this is an example that kind of describes why our process, I think, works so well. First of all, we have a great analyst covering it. We actually have 2 analysts covering most of our banking universes. So there's 2 analysts doing Switzerland. So if one's away or one they want to discuss and debate, they can get differing views. But you see here that Credit Suisse had this run on the bank in March, triggered by the SVB debacle. But it wasn't its first run. It actually had a run on the bank in the 4th quarter of 2022. And you see up here, Elsa, who's on our team, a fantastic analyst, been with us for 10, 12, 14 years. She wrote 12 different articles published on the research system, in addition to the one-to-one chats, in addition to meetings and conferences with PMs. But she wrote 12 in just a 2-month period, and ended in December 2022, noting that, okay, they're encouraging signs from the chairman on liquidity, but the situation still remains fragile. So when March happened, again, we didn't predict SVB, but when March happened, we were ready. We had an understanding of what the issues were with Credit Suisse. We had an understanding what the valuation might be. We had an understanding what scenarios might be. And we published another 6 or 7 articles then. So we were following all these events all along. And fortunately, because we understood the risks and were able to value seniors and subs in different scenarios, we felt pretty comfortable that there was certainly risk in the seniors, but it may be a risk worth taking. And we felt less so on the AT1s, and we put those on what we call our risk list in advance of this. But the interesting thing here is, okay, we did well with Credit Suisse. We're on it, we're ahead of the time, and we dedicate the resource to it, and it paid off. But if you go to the next slide, I think this is where the real interesting thing comes up. Credit Suisse triggered widespread selling of most bank bonds, and certainly all AT1s. Now, for us, that's manna from heaven. Right? That's an opportunity. So we go into this saying, look, we know which the strongest banks are, most resilient to this event. We know what the regulatory regimes are. So we know how the UK is going to treat AT1. At least we hope we do. We know how the US is going to treat their perps, and we know how the ECB will. And we even, just a couple days after the event when the AT1 write-down occurred for Credit Suisse, the Bank of England and the ECB both put out publications that said, we are going to respect the hierarchy of the capital structure. So that takes a lot of risk away. So we know which banks are most resilient to these types of deposit runs and fear in the market. We know what the regulators are thinking, and we can go to Richard and the other PMs and say, hey, here are the AT1s, here are the bonds that we think make most sense. It doesn't last all that long, this significant market reaction, but we were able to purchase this bond 800 basis points wider than where it was. And
so this is HSBC?
Sorry, this is the HSBC one. So HSBC was still a strong bank. It's one of the best deposit-funded banks. There is geopolitical risk, but in terms of deposit run, pretty low risk. And that was what people were fearing in March of 2023. So we look at the whole other universe, the US regionals, the US G-SIBs, the major banks, and all the European ones, and we're ready to react to whatever the market gives us. If the market only gave us 100 or 200 basis points of spread widening here, we can help price that risk and say maybe it's not that attractive. But when the market gives you that, and you're comfortable with the risk, we want to jump on it. So we can react quickly and then be patient in terms of it's coming back to really tight levels. And I kind of argue now it's at pretty darn tight levels.
Yeah.
So it's just a good example of being prepared, not knowing what the event will be, but being prepared and willing to take the appropriate risks when they present themselves. And you have to have a big credit research team to do that. There's no shortcuts to fundamental research.